Interest rates rise again, but the good news is that the pace of increases might start to slow. Farmers set for a bumpy year thanks to plenty of rain and high prices, and the AFL signs a new record deal for broadcast rights. It's Wednesday, the 7th of September 2022. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Now, Sean, you had a pretty big day yesterday, obviously. Reserve Bank yesterday, then GDP out today. Are you getting any sleep?
No, I'm worried about my mortgage. That's 50 basis points.
Putting aside the work element of it and knowing that you're going to have to kind of sift through a great deal of information, there's a very kind of human part of this going, this is going to cost me more.
Yeah, it sure is. I mean, the lift in interest rates since April is quite incredible. In fact, it hasn't been, not since the 1990s, the early 1990s, have interest rates risen by as fast as they have over the past few months. And remember, 6 months ago, we were being told that there wouldn't be any hikes till 2024.
I think I mentioned previously that we bought our first place in, I think, November of 2010, which is, I think, like a month after the Reserve Bank increased rates for the last time, basically. And so since then, we had never experienced an interest rate rise. Well, I tell you what, we sure have now, haven't we?
We're catching up now, that's for sure.
And now you've got a chat coming up after the show with Dr. Edwin van der Oudere from Accenture, which is really all about how consumers have changed their behaviours and then, as a result, what business needs to be doing about that.
Yeah, it's really, really fascinating. All about big data, about understanding not just cohorts of people, but individual customers. And data allows you to do that. And if you can manage that data, you can really improve your customer service. And suddenly customer service is no longer a cost center. It's actually a way of winning business. Fascinating chat.
God, you love data, don't you? You really do. You get so excited whenever someone mentions it.
I wish I could manipulate it myself. I'm not much good at that, but it's just so powerful.
Yeah, it is a really interesting conversation, this one. So stick around for that. But the main story this morning, of course, is the Reserve Bank of Australia lifting the official cash rate by another 50 basis points yesterday, taking the total increase since May to 2.25 percentage points. And there are more rate rises on the way, it seems.
Yes, bad news all round if you're trying to fund a mortgage, but perhaps not if you're a pensioner relying on term deposits. On a $750,000 mortgage, the 0.5 percentage point increase will lift the monthly interest bill by another $220. Now, compared to back in April, borrowers will be paying around $920 more each month on a $750,000 loan. That's quite a whack. The speed in which interest rates are rising hasn't been seen since the early 1990s, and just 6 months ago, of course, was deemed highly unlikely. But inflation is soaring. The Reserve Bank thinks it's going to hit close to 8% by the end of the year, and the bank, like other central banks around the world, is determined to get control of price rises.
Speaking of the central bank, what did they say about the economy and then the likelihood of further rate rises?
Well, Governor Philip Lowe said the board was committed to returning inflation to the 2 to 3% range over time, and he expects further rate rises, though there is no preset path. It will depend on economic data. There was, however, a hint that the pace of rate rises might slow when Dr. Lowe said yesterday's decision would help return rates to a more neutral level. They dropped language about normalising rates. Many economists think, this means the central bank will now start to slow the pace of rate hikes, essentially take a breather and see what happens. Of course, there's a risk here. If they keep lifting rates, they could really kill off growth and send the economy into recession, which is the last thing they want to do. Well, it's probably not. The last thing they want is higher prices and inflation. The second last thing they want is a recession. So the whole point here is that they might just take a breather now and see what happens for a bit.
Sean, I know the government's only been in power now for nearly kind of 3 months around there, but it seems like this is fast going to become a political problem.
Yes, perhaps it already is and we don't quite realise it yet. We've got much higher interest rates. We have inflation and a big jump in the cost of living. We can see that in petrol prices, for example. I suppose at least some food costs have fallen in recent weeks. $1.80 for an iceberg lettuce yesterday, Michael. Just like to boast. Anyway, I digress.
You do boast about some strange things sometimes, but I do appreciate that.
And next month, we've got the federal government's budget, and they're promising that it will be tough, including measures to increase the tax take as it tries to repair the blowout in the federal deficit, which occurred during the pandemic. Federal Treasurer Jim Chalmers yesterday said while the Reserve Bank's decision wasn't a surprise, that's cold comfort for households, and people will have to make tough decisions about how to make ends meet. Now, I do think it's worth adding a bit of context here. Interest rates are still low by historical standards, just not by recent standards, which is what people have gotten used to. That's your anecdote at the top of the show. You've only ever owned a house while interest rates were falling. A cash rate of 2.35% is the highest since late 2014, but for at least 25 years before that, the cash rate was actually higher. So we do need to bring some context to it.
Yeah, certainly helpful. It was a big day yesterday, obviously. How did the share market react to the interest rate decision?
Well, it had been trading reasonably flat, but then sold off in the final 90 minutes after the Reserve Bank's 2:30 p.m. announcement. By the end of the session, the S&P ASX 200 closed down 0.4% to 6,827 points. The utilities and materials sectors were the worst performers, while the tech companies did best. Now, Michael, there are plenty of companies going ex-dividend at the moment, and that depresses their share price on the day because buyers of shares on that day won't receive the dividend, hence ex-dividend. So it is just a bit tricky, or investors need to be careful of that when you're looking at daily price moves. Yesterday, the banks were lower, the big miners were mixed, as were the energy companies. Wesfarmers fell 1%, Woolworths was lower, and Coles was flat. Among the large caps, insurer QBE was the best performer, up nearly 2%, while WiseTech Global, Ramsay Healthcare, and ResMed all did well. The top performer yesterday was uranium miner Paladin Energy. It jumped more than 7%. Worst was Super Retail Group, which fell more than 6% after going ex-dividend.
All right, what about international markets?
Well, the rates decision didn't have too much of an impact on the Aussie dollar, which appreciated slightly after the announcement. It's currently trading around that 68 US cents mark. It's really hard to ignore what's going on in international energy markets at the moment, with prices soaring as Russia further restricts output to the Euro region. The Financial Times is reporting that the European Commission wants to introduce caps for gas prices to tackle the energy crisis and keep a lid on inflation. And remember, we reported yesterday that the German government will impose a windfall tax on electricity producers to finance relief measures. One local company that's benefiting from all this is Woodside. I'll tell you a bit more about that shortly.
All righty, we'll be back in a moment then with the rest of the day's business news. Sean, the Reserve Bank might have dominated the economic agenda yesterday, but there was other news, and Australia recorded its 13th consecutive current account surplus.
The surplus jumped to $16.3 billion in June, mostly thanks to soaring coal prices, according to the Australian Bureau of Statistics. The value of the country's exports rose nearly 15%, while imports were up less than 5%. The strong trade numbers, which reflect a massive 40% rise in coal exports, should add about 1 percentage point to the official economic growth figure. We'll get that one late morning today. Annual exports of coal last financial year rose above $100 billion for the first time. Of course, this reflects much higher prices as a result of the war in Ukraine. Another notable in the figure was a strong pickup in tourism as well. Both inbound and outbound tourism did much better during June.
And coal isn't the only commodity having a good time of it at the moment, Sean. Australia is forecast to sell $70 billion worth of agricultural products overseas this financial year.
Yes, that would be a cracking year. The sector will produce another $12 billion on top of that of products that'll be consumed locally. The latest Australian Bureau of Agricultural and Resource Economics and Sciences forecast, ABARE for short, Michael, just in case, but I thought I'd get that all out.
It's quite a mouthful, isn't it?
It is. ABARE's forecast reflects both favourable growing conditions and high global prices. Wheat's expected to be the number one agri-export, worth about $12 billion. Beef's next at just over $10 billion. The national herd is now returning to pre-drought levels. It really was destocked for a few years there in the midst of that drought. It's taken a while to come back. Cotton is the number three exporter, expected to be the number three export at about $7 billion. The biggest risk to the outlook, according to ABARE, is an outbreak of foot and mouth disease. Let's hope that doesn't happen.
Yeah, absolutely. Now, Sean, Europe's former biggest buyer of Russian gas, Germany's Uniper, has signed up for more LNG from Woodside Energy as it hunts for replacement sources of supply after the invasion of Ukraine.
Yeah, this is an example of an Australian company benefiting from the tragedy that's going on in Europe at the moment. The loss-making utility, which has had to be bailed out by the German government amid Europe's escalating energy crisis, will buy up to 12 LNG cargoes a year from Woodside's trading business in Singapore starting in January, according to the Financial Review. The LNG is likely to come from Woodside's portfolio in the US rather than Western Australia, highlighting the tyranny of distance challenge for local producers. Still, Woodside is in the market with European buyers interested. That's a very good thing for Australian companies.
Yeah, it's a good position to be in. Now, yesterday we highlighted the coal producers and their incredible share price performance. Today, it's lithium, with the share price of several producers soaring.
In fact, it's the only sector that can give coal a run for its money at the moment. Yesterday, the share prices of lithium companies jumped sharply yet again. Core Lithium was up 9%, taking its increase over the past year to nearly 300%, easily the best of the top 200, better than the coal companies. Other lithium plays to jump yesterday included Pilbara Minerals, Lake Resources, Allkem, and Liontown Resources. Why is it happening? Well, lithium goes into batteries. That's all part of the green energy revolution, from electric vehicles to smartphones. Lithium prices peaked back in March. There was then plenty of publicity about a potential oversupply of lithium. Now, in more recent weeks, several businesses have come out and said, what are you talking about? Electrification is going to go on for decades and decades, and there'll be strong demand for the metal, for lithium, for a long time to come. Suddenly its price started heading north again, so too the share prices of lithium producers. Quite an incredible time to be in that market.
I'd love to know which companies came out and said, what are you talking about? It feels like a nice little bit of colour to it there, Sean.
It does. Well, Tesla, for example, came out and said, there's going to be a lithium boom for a long, long time. Now, obviously, they're talking their own book because they make electric vehicles, they need lithium. The more supply, the better for them because that'll push down the price. But that was an example of a company saying, hey, of course there's going to be lots of demand for lithium in the next few decades.
Yeah, what are you talking about? Yeah, absolutely. All right. Now, anyone, Sean, who's been on Sydney public trains recently would know that the barrier gates are always open. Yet, 90% of people, I think this is pretty extraordinary, 90% of people are still tapping on and paying.
They're an honest bunch, those Sydney-siders, no doubt about it. Ongoing industrial action has meant gates are normally open and commuters don't actually need to tap their Opal cards. It was estimated that taxpayers lost $3 million over the past 3 weeks because of the action. It would have cost much more, but 9 in 10 commuters are still tapping. The New South Wales Government and Unions New South Wales are negotiating a new enterprise agreement for rail workers. It was due in the Fair Work Commission yesterday afternoon. I've got to say I've used the rail network in Sydney over the past few weeks, and I always tap because I actually think it's a pretty good service.
Yeah, look, I wouldn't be able to do it just because I am so respectful of authority that I would just live in fear of a transit officer or someone coming along going, hey, excuse me, have you tapped? I'm like, sorry, sir. Yeah, I live in fear. All right, now, Sean, we mentioned this one at the top of the show. The AFL has signed a record broadcast deal with free-to-air network Channel 7 and pay TV provider Foxtel, which will keep the code with the two networks for another 7 years.
That's right. It's a deal worth around $4 billion, signed yesterday by departing AFL Chief Executive Gil McLachlan, and it goes from the 2025 season through to 2031. Foxtel's Kayo will have rights to all the games, while there will be the same number of games on Seven's free-to-air channels, including marquee matches. AFL Chair Richard Goyder said the historic deal would allow the AFL to invest in the grassroots of the game and keep it affordable for fans. Certainly, if it is $4 billion, and some reports suggest it's up to $4.5 billion, a massive win for the AFL.
That is a huge amount of money. That's an incredible result.
It's an incredible investment also from Seven and from Foxtel. 10 and 9 both bid for the rights, but they didn't come, or they came up short. Still, it's a lot of money for a media outlet to be paying.
Yeah, sure is. All right, moving on to overseas news. And Volkswagen has decided to push ahead with its plan to list a minority stake in the Porsche sports car maker in what could be one of Europe's biggest initial public offerings of the year.
Yes, the listing is likely to value Porsche at about $85 billion US. The share sales could well allow the Porsche and Piesch families to once again regain direct influence over what used to be a family company. Now, 13 years ago, the family was forced to sell the business to Volkswagen for financial reasons. For its part, VW wants to take the funds from any IPO and invest it in electric vehicles, which, like everyone else, it thinks is where the money should go.
Sean, Singapore is an economy on the move, introducing a new overseas networks and expertise visa. That's what it's called, overseas networks and expertise visa, to try and attract skilled workers.
That's right. A senior government official said it simply when he commented that Singapore wants to bring in rainmakers with this new overseas network and expertise, one visa. The city-state won't limit the number of applicants for its newest work permit, and it will allow individuals and their partners to work for 5 years. It's a very aggressive push to attract skilled labour. Now, all this is happening as Singapore revives post-pandemic. For example, hotel rooms are now the most expensive they've been in Singapore in almost a decade, and 5-star rooms now cost more than their Sydney equivalents. But they're still cheaper than Hong Kong and Tokyo, mind you. The city will also welcome back the Formula One Grand Prix at the end of this month. Singapore is certainly on the move.
Yeah, it sure is. And of course, congratulations to Liz Truss, the new Prime Minister of Britain, who beat her opponent, former Chancellor Rishi Sunak, by a 57-43 margin.
That's right. Prime Minister Anthony Albanese and opposition leader Peter Dutton welcomed the incoming Prime Minister to the job. Mr Albanese was due to speak to Ms Truss last evening. She's the third woman to hold the office, and given in her younger days she was an anti-monarchist, her relationship with the Queen would be interesting, I'd imagine. She was also anti-Brexit, though now she says she's a supporter. It appears that her first order of business is to finalise a 2-year energy relief package expected to cost around £100 billion. Good luck to Ms Truss.
Yeah, absolutely. And as we were saying yesterday, after 7 weeks of being in limbo, at last there's a bit of certainty, and maybe the country can start moving forward again.
Exactly.
Okay, up next is the Fear and Greed Daily Interview, and your guest today is Dr. Edwin van der Oudera.
Yes, any man that wants to talk about data and how you can apply it to consumers is okay with me, and that's what it's all about. Really fascinating. Particularly, when you've grown up on talking about cohorts of people and say you're selling to a particular style of person, this is all about individualism and using data to sell to an individual rather than a cohort. Fascinating.
Yeah, and if you want to hear Sean very excited for about 12 or 13 minutes, then stick around. It is coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Wednesday, the 7th of September, 2022. Make sure you're following the podcast. Join us online on LinkedIn, Twitter, and Facebook. And don't forget, if you haven't had a go at listening to us via your smart speaker, just say, play the Fear and Greed podcast, and it should start playing. I'm Michael Thompson, and that was Fear and Greed. Have a great day.